Let's talk about Ray Dalio, his prediction concerning a once-in-a-lifetime Great Depression type big debt crisis being on the way, and what that means for investing right now. First off, your time is valuable. Why should you care what Ray Dalio says? It might help if I told you why I spent a week reading Ray Dalio's book. I did it because I felt a duty to protect my mother. My mother's savings need to last several more decades, and I felt it was my duty as her son to read Dalio's book because, number one, he makes some very scary predictions, and number two, what he says seems to ring potentially true to me based on my understanding of economics and finance. But let's get into specifics. Point number one, how scary are his predictions? So scary, in fact, that even if there is a 1% chance he is correct, it bears investigation. It's not the odds, it's the stakes. Ray Dalio predicts that a once-in-a-lifetime financial disaster is probable and possible soon, and it will be caused by, as he calls it, a big debt crisis. A crisis caused by too much debt. When you were in high school, do you remember being taught about the Great Depression? Do you remember seeing black and white photos of people who, before the Depression, were rich, and after the Depression hit, were incredibly poor wandering the West living in their car? Do you remember seeing panicked stockbrokers huddled on the streets of downtown New York? Do you want to avoid this happening to you? The size of this predicted disaster is huge, akin to crises, which in the past caused the Great Depression, the hyperinflation of the Weimar Republic in Germany post-World War I, and the French Revolution. Often, debt crises of this size are followed by large-scale wars and revolutions. Ask yourself, it's 1928, a year before the Great Depression. Where would you put your savings to protect your family during the upcoming crisis? Point number two. So the prediction is scary. But who is Ray Dalio? Ray Dalio used to run the largest hedge fund in the world. Theoretically, he knows what he is talking about. This argument holds less water for me. As Warren Buffett used to say, if you put 1 million people in a room flipping quarters, one of them is going to flip heads 100 times in a row. That does not make them highly skilled at flipping quarters to land on heads. The critical point for me, though, is this. Ray Dalio's analysis is very logical and rests on one scary argument. Going back to Roman times, historically big debt crises tend to occur when two things happen simultaneously. First, a nation's debt to GDP rises above 250%. And second, a nation's political system is deadlocked or not acting super rationally. Guess what the debt to GDP ratio is for the US right now? It's above 250%. Please note, many viewers have commented that US total debt is not even near 250%. This is because many viewers assume total debt is defined as just US federal debt. But Ray Dalio defines total debt as US federal plus state plus local plus private debt. How would you characterize the political climate in the US right now? Is it getting better? So my proposition to you is this. Ray Dalio is a relatively credible person. He is predicting a once-in-a-lifetime financial crisis. This prediction is so dire it may be worth spending 30 minutes talking about it with me to make sure either A, the predicted crisis isn't real, or B, it is potentially real, so it makes sense to discuss how to prepare for it. What is Ray Dalio's big debt crisis theory? In a nutshell, it's this. Why did the Roman Empire fall? Why did the Great Depression happen? The answer: rich people get lazy and pile on debt. Eventually, that debt kills. Ray Dalio's basic point here is that throughout human history, as nations or empires get older, they tend to pile on a huge amount of debt. Eventually, this debt ends up threatening the survival of the nation. He says this happened to the Romans, to the French before the French Revolution, the British Empire before its decline, etc. There are tools available to solve this kind of problem, but these tools require players within the nation to trust one another and put the greater good ahead of personal gains. When this unity disappears in the body politic, the unnecessary bad outcome becomes the inevitable bad outcome. The idea that when a nation faces a crisis or a common enemy, A nation's factions do not unite to confront the enemy seems counterintuitive. But in psychology, there is the idea the smaller the stakes, the meaner the people. Or, put another way, when there are 30 people in a room and one slice of pizza, what happens? One example comes to us from ancient Rome. Towards the end of the Roman Empire, there were enough legions to defend the borders from foreign invaders. But instead of unifying to attack the invaders, what happened was civil war. Roman legions were used against fellow Romans instead of against the invaders. As I said, this may sound illogical, but it is a very human trait. When things get scary, sometimes people get selfish. So let's review Ray Dalio's overall theory and see if it holds water. I encourage anyone that holds bonds or real estate to read his book Principles for Navigating Big Debt Crises. Ray Dalio analyzed over 2,000 years of financial history. He then took an in-depth look at over 300 financial crises. He took all this data and looked for common patterns. He found a common pattern and he called it his theory of big debt crises. In a nutshell, he found that on average every 50 years or so, there is a big debt crisis. Ray Dalio says big debt crises come in two flavors, deflationary and inflationary. If you were forced to choose one, you want deflationary. Why? Because deflationary depressions are a lot easier to manage. Deflationary depressions are depressions characterized by falling prices. For example, during a deflationary depression, the price of bread will seem to fall every year. Deflationary depressions typically happen in wealthy countries that control what are called reserve currencies. What is a reserve currency? To explain what it is, let's look at an example. The US controls the US dollar, and the US dollar is a reserve currency. Most nations on Earth keep large holdings of US dollars on their balance sheets to help facilitate international payments and bolster their own national currencies. This is why it is called a reserve currency. It's held in reserve for daily use and for a rainy day. For reasons to be explained later, one of the benefits for a nation of controlling a reserve currency is you get depressions that are a lot easier to manage. Inflationary depressions are much scarier than deflationary depressions, because in some cases, economists are not totally sure how to fix them given reasonable political parameters. And sometimes they just spiral out of control, causing incredible hardship for a nation's citizenry. Inflationary depressions are characterized by rising prices. For example, in post-World War I Germany, workers would have to cart their salary around in wheelbarrows when going out to buy bread, since the stacks of paper currency needed to buy bread weighed so much. Often, hyperinflation is accompanied by devastating social unrest. Many attribute the rise of Hitler at least partially to hyperinflation in post-World War I Germany. Let's first take a look at deflationary big debt crises. Once we have looked at deflationary depressions, we'll look at inflationary big debt crises and see how they differ. A deflationary big debt crisis typically has 7 stages, and these stages roughly correspond to the typical rise and fall of an empire. Stage 1 is called the early part of the cycle. At this stage, a nation is on the rise. It is young and vibrant. Most importantly, it has very little debt, and the debt it does take on is used for productive purposes. It borrows money for projects which cause the nation's income growth rate to exceed its nominal debt rate. In other words, it borrows money, and that money is used to generate income. At this stage, its income is growing faster than its debt, so it's piling on the cash. And through the wonders of compound annual growth, its income growth rate exceeds the rate it pays on debt. Its cash is just growing exponentially. Life is good. Stage 2 is called the bubble. At this point, people start to get greedy. They push it. And the low-hanging fruit investment ideas are all used up, so they do what humans do and what children do, and they look at regulations which have been set up over generations to prevent bad outcomes, and they say, how can I skirt these regulations to make a little extra money? At this point, typically, 2 magical inventions arise. Number 1. New and exciting financial instruments are created to bring the wonders of modern finance to the everyday person. And number 2, new and exciting financial institutions are founded to lend money to the world, but they operate outside the burdensome world of the regulated financial industry. During this period, a self-reinforcing cycle begins. People borrow more money than they should, more than their incomes can justify. And what do they do with that money? They spend it. This causes company earnings to rise, which causes the valuations of these companies, in other words, their stock prices, to rise. Bankers look at all this and say, hey, look at this. Incomes are rising, company profits are rising. Company valuations, therefore, are rising. Since we lend based on income and collateral and both are rising, I guess that means we can lend more. Oh, and if we lend more, interesting, our salaries and bonuses go up as bankers. And so banks lend more, and people borrow more and spend more and on and on. As things spiral upwards, it all seems so logical and safe. Incomes and valuations are rising, so everything seems safe from a lending standpoint. Stage 3 is called the top. At this point, debt and valuations have reached their highest levels and are, as Ray Dalio says, ripe for a reversal. Stages 1 through 3 combined usually last about 50 years or so. During these 50 years, several business cycles occur. What is a business cycle? Every 8 years or so, there is a recession. Each recession represents one business cycle. So each big debt crisis spans 50 years or so and includes several business cycles which span 8 years or so. During this period, debt to GDP rises for the nation. On average, at the end of the top stage, or stage 3, nations have piled on a debt to GDP ratio of 250+%. Numbers revolving around national debt are so huge it is normal for the mind to blank them out. What exactly does $1 trillion mean? It sounds like science fiction, or the word gazillion. To put these numbers into perspective, let me compare them to the numbers for an individual household. As a caveat, it is fatally misleading to think of it this way, and I'll explain why later, but to put these numbers into perspective, let's pretend they apply to an individual household. At the end of stage 3 or the top, a debt to GDP ratio of 250% is kind of like saying you make $100,000 a year, and you have $250,000 in debt racked up between your credit cards, mortgage, and car payments. So at the end of stage 3 or the top, we find a nation with a lot of debt when compared to historical norms of other nations over a 2,000-year period. But most importantly, the money the nation is borrowing is not going to fund productivity-boosting projects, unlike at the beginning of the big debt cycle when the money was being borrowed for productive purposes. A significant portion of the borrowing at the top stage is going to borrow more money to service existing debt. This is like taking out a home equity line to pay the interest, not the principal, on your credit card bill. If your coworker was doing this and they asked you to borrow $10,000, would you lend them that $10,000? Ray Dalio says even with debt to GDP in excess of 250%, this top-line number is not necessarily unsustainable. But he also says that when you look at history, statistically, it is at this debt-filled, vulnerable point when a catastrophic asset bubble gets ready to pop. The bubble itself typically is formed and begins to inflate aptly enough at the tail end of stage 2, which is, you will recall, called the bubble. But why do asset bubbles form repeatedly throughout history? Ray Dalio says it comes down to human nature. People get greedy and just try and push things a little too far. In stage 2, the economy spent close to 50 years borrowing beyond their means in a self-reinforcing upward cycle. During this exuberance, players keep looking for new avenues to make more money, and eventually they overreach. To determine if a system-threatening bubble exists, you usually need to dive into analyzing individual sectors to see if a bubble exists in one sector, but that bubble has been hidden by averaging the bubble sector with less leveraged sectors in the economy, thus hiding the scary number in the overall debt to GDP number. So where are we now? We have gone through the first 3 stages of the big debt cycle: the early stage, the bubble, and the top. These 3 stages last in total about 50 years. During this period, debt to GDP has slowly risen to, on average, in excess of 250%. And at this point, there may or may not be a dangerous asset bubble hidden somewhere. But we are still missing one key element. Playing an Overwatch role over this whole drama, acting as guardian for the economy, is the central bank. And during this 50-year period, a sinister dynamic has unfolded, which has slowly robbed the central bank of its ability to protect the economy. Why do central banks exist? Human beings tend to figure problems out, and they come up with solutions. During the Dark Ages in France, French villages would constantly get plundered by Vikings. So French people decided, hey, this is no fun. Let's build stone walls around our villages and cover our warriors with armor and put them on gigantic horses. In a similar vein, throughout history, kings and dictators would print money, debase gold coins by mixing in lesser metals, and use monetary policy as their personal piggy bank to maintain power. But this activity would cause horrible economic depressions and suffering. So at a certain point, civilization said, hey, let's take monetary policy out of the hands of politicians and kings and create independent institutions who only try to help the greater economy and are largely immune to political pressure. Hence the Fed. Hence independent central banks. In order to understand why bubbles cause depressions, we need to understand how central banks end up weakening themselves, so at the most important point in the crisis, when action is most needed to combat a bubble, central banks are often left in a very weak state. In the United States, the central bank is called the Fed. And the Fed sees its role as managing the economy to simultaneously promote growth while managing inflation. Growth versus inflation. Over this 50-year period we've been discussing, as each recession business cycle occurs, the Fed jumps in to combat a recession by lowering interest rates. Why does it do this? There are two ways to make an economy grow for the long term. One way requires hard work. One way is very easy. The hard way is to do something called boost the growth potential of the economy. But this involves doing difficult, painful things like improve the education system, build infrastructure, create a more effective tax system. Often, political concerns make these types of activities very difficult. The other way to make an economy grow is to lower interest rates. This is very easy. You just lower a number. As with so many other things in life, however, the easy way often ends up turning into the hard way. Taking the easy way to spur growth by lowering interest rates instead of doing the hard work like negotiating a more effective tax system is kind of like a doctor telling a patient they need to lose weight, but instead of sitting with the patient to get them to eat more vegetables and exercise, the doctor just gives them a whole bunch of diet pills. The diet pills work at first, but over time they wear down the body. As an aside, the Fed is not to blame for this. During this 50-year cycle, it is the responsibility of the executive and legislative branches of government, the President and Congress, to boost growth potential. But if these branches fail to do so, it leaves the Fed with no other choice but to lower interest rates to combat recession and economic decline. The President and Congress dig the hole. The Fed fills it. Lowering interest rates works at first, but in the long run, it leaves central banks in a weakened state at the worst possible time and makes the economy overall more fragile. How does this happen? When you lower interest rates, it boosts growth in the economy by doing three things. First, there is a wealth effect. When you lower interest rates, the present value of things like stocks, bonds, companies goes up. The mechanism behind this is beyond the scope of today's talk, but it relates to something called net present value and discounted cash flow valuation. Second, there is an income growth effect. Lower interest rates makes it cheaper to buy things like washing machines on credit. When things are cheaper, people buy more. Third, there is a debt service effect. Lowering interest rates reduces the monthly payments people have to make on existing debt like car payments, freeing up cash for them to spend more on things like food and housing. All this sounds great. But think about what is going on here. Whenever you run into trouble and you hit a recession, you are boosting growth by lowering the interest rate. So we see that the power to lower an interest rate is the Fed's main tool. The problem is with each successive recession, the Fed often ends up lowering interest rates further and further. So for example, in the 1980s, interest rates were in the mid-teens, and with each successive recession, rates declined, first to the low teens, then to 8%, then to 6%, etc. What happens, though, when interest rates hit 0%? Practically speaking, the Fed can't reduce rates below zero. At this point, the Fed's main weapon, their most proven tool to combat recession, is no longer available. So let's recap now with this new information. At the start of the big debt cycle, there is little debt, and governments are doing the hard work to boost an economy's growth potential by doing things like investing in the education system and investing in hard science. Then governments stop boosting growth potential, so the economy stops growing as rapidly. But the political system still demands growth, so when cyclical recessions hit, the central bank lowers interest rates to spur growth. But over several business cycles, this causes cumulative debt to rise at the same time as a central bank's main weapon to fight depressions loses its power, because rates often end up declining close to 0%. Debt rises while the main weapon available to fight the dangers of debt fades. With each successive reduction in interest rates, the central bank's main weapon becomes weaker and weaker. At the end of this 50-year big debt cycle, we are left with an economy saddled with debt and a central bank that does not have a lot of gas left in the tank. This leaves an economy in a vulnerable position, ill-equipped to dealing with a dangerous asset bubble. Unfortunately, as we discussed, the problem is, historically, it is at this stage in the cycle, when debt levels are high and central banks are weak, that asset bubbles are often ready to pop. Often, these bubbles are related to new types of financial instruments and/or new financial institutions which fall outside traditional regulatory oversight because they are new. As Ray Dalio says, historically, the greatest depressions occur when bubbles burst. So if there is a bubble, what finally causes a bubble to burst? Typically, what causes a dangerous bubble to burst is during the final business cycle in this 50-year big debt cycle. Central banks notice frothy growth and inflation, and they do what they usually do, and they raise interest rates to tamp down growth before inflation gets out of hand. To reiterate, during a 50-year period, there are typically several business cycles. And to recap, a business cycle is usually defined by a recession. But in this last cycle, when the Fed raises interest rates, borrowers in a sector of the economy that is in full bubble mode can't take that last increase in interest rates. This last interest rate increase is the straw that breaks the camel's back. A few borrowers can't pay a higher interest rate on the money they used to borrow in order to buy a bubble asset, and they default. Then banks start to get worried other borrowers in that bubble sector will also default, so they stop turning over loans and they start raising interest rates on loans they leave out there, which causes more borrowers to default, which reduces spending because bankrupt people can't buy bread. And so the self-reinforcing cycle that powered the economy up during the bubble phase starts to reverse and becomes a self-reinforcing cycle downwards. The danger arises if it turns out the bubble asset was so huge or held by so many people that a collapse in the bubble asset ripples through the economy, and this contagion spreads to what are called systematically critical financial institutions, like Goldman Sachs or Bank of America. These so-called critical institutions do most of the lending which the general economy relies upon for daily existence. They are the ones that make sure there is money in the bank, so bakers can buy wheat to make bread on Monday, and Ford can buy steel to make cars on Tuesday. If critical financial institutions collapse, then the general economy as a whole risks a truly catastrophic, in the literal sense of the word, and immediate disaster. Once again, let's take a step back. We are now in the middle of stage 3, in other words, the top. The situation is, number 1. The economy has taken on a whole bunch of debt. Number 2. The central bank's main weapon to fight financial crises has been taken away because interest rates are hovering near zero. Number 3. There may be a scary economy-shattering bubble lurking somewhere hidden in the national balance sheet. And this bubble is so big, if it pops, it might destroy critical financial institutions like Goldman Sachs, causing catastrophic contagion. This is the archetypal pattern Ray Dalio has seen over the past 2,000 years for the conditions which typically preceded big debt crises and deflationary depressions. This pattern has occurred again and again, hundreds of times. We have now entered stage 4, or the depression. In a morbid and scary way from an economist's perspective, this is where things get simultaneously interesting, suspenseful, and truly frightening. Without an ounce of exaggeration, in a very literal sense, it is at this point in the crisis where a couple weeks of bad decision-making by politicians and central bankers could throw billions of people into prolonged grinding poverty. If you are a human being who is capable of feeling empathy, this thought is very disturbing. This may sound like hyperbole, but for anyone who has studied macroeconomics, it is quite quantifiably real, and there are so many equations to prove it. For example, most people do not realize how exceptionally close to catastrophe the world economy came during the great financial crisis of 2008. So let's begin. We are at the very beginning of a Great Depression event. Somewhere in a dark corner of the vast global financial system, a bubble has popped. On trading terminals across the world, puzzling data begins to blip. Money is lost. Bosses are called. And those bosses call in the geeks to explain what is going on. In Ray Dalio's terminology, a debt-death spiral has begun to unfurl. The following explanation is a bit generalized and simplified for the purposes of this video. If you are interested in a more detailed explanation, I encourage you to read Ray Dalio's book. At the start of the debt-death spiral, a large number of important banks fail, taken down by the bubble bursting. Think about how you buy bread. When you go to buy bread, most commonly, you either use money you withdrew from a bank's ATM or you use a credit card issued from a bank. If your bank were to fail today, where would you get money or credit to buy bread today? If you were a baker and your bank failed, where would you get money or credit to buy flour to bake bread for your customers? The FDIC protects most personal accounts, but business accounts routinely exceed FDIC protection limits. During a depression, many businesses would face a serious risk of losing much of their cash forever. When banks fail, consumers and businesses alike cannot get money and/or credit to buy goods or make goods. Because there is suddenly very little cash and credit to purchase and make goods, economic activity as a whole drops rapidly. When economic activity drops, businesses lose money, and employees of those businesses get laid off or see their hours reduced. Some of these stressed businesses and employees in turn default on loans made by banks that survived the initial wave of bank failures. This in turn brings down many of these surviving banks. Why? Banking systems worldwide operate on something called the fractional reserve system. This means they are typically levered 12 to 1 or 15 to 1 as a matter of course. With this amount of leverage, the default of a relatively small portion of a bank's loan portfolio can cause the bank to collapse. And the withdrawal of a relatively small portion of a bank's deposits by frightened depositors can also cause a bank to collapse. Due to the fragile, leveraged nature of the entire banking system, if bank failures are not contained quickly and economic activity is not revived quickly, the contagion spreads in a rapidly accelerating fashion, akin to a wildfire of fear. Bank failures will continue to spread at an almost exponential rate. Each wave of bank failures turbocharges the next stage in the debt-death spiral, with each successive stage producing more and more damage. It's the frightening math of leverage. Compounding the above-mentioned problems are two more problems. First, borrowers are strapped for cash to repay existing loans, so they resort to selling assets like stocks, bonds, and real estate, etc., to raise cash so they do not go bankrupt. But since everyone is trying to sell assets all at once, the prices of these assets are dropping rapidly. The stock market is tanking. This adds another layer of fear to the economy. Second, the lenders that have survived are still offering credit, but the interest rates on that credit have risen dramatically. Why? Because lenders are rightfully worried about getting repaid during a crisis. Rising interest rates lowers debtor fundamentals, which causes lenders to raise rates even more, which lowers debtor fundamentals even more, and so on. In other words, since creditworthiness is determined by ratio of collateral to debt and income to debt payments, since collateral prices are dropping and income is dropping, creditworthiness drops, so less lending economy-wide occurs. Less lending further reduces overall economic activity, and so on in a debt-death spiral. Eventually, even more debtors and lenders go bankrupt. The deadly effects of higher rates spread to so-called safe areas of the economy. How would you fix this problem if you were the president or the head of the Federal Reserve? Please remember you need to move quickly. Every hour and every day counts, given the leveraged nature of the financial system. Bank failure can spread like wildfire unchecked. How would you fix things within just days? In order to understand how to fix a problem, it is important first to understand what the problem is. Before the bubble burst, the real economy was doing fine. By real economy, I mean the part of the economy that consumed and produced real-world goods and services. Bakers knew how to bake bread. Consumers knew how to eat bread. Everything was fine. So what changed? When the bubble burst, it broke the financial world. It killed off a large number of critically important banks. Banks died. Who cares? Banks provide money and credit. Money and credit are used as a means of exchange to purchase and sell real-world goods. Let's say you are in charge of the government. Before the bubble burst, $1 trillion in money and credit was required in the economy to facilitate daily transactions. But after the bubble burst, it took out several systemically important financial institutions. Given the concentrated nature of the financial system, these failed institutions accounted for, let's say, $400 billion of the money and credit in the economy. So now, after the first wave of bank failures, there are only $600 billion in money and credit in the system. But before the bubble burst, the economy needed $1 trillion to function. This rapid disappearance of credit causes a rapid drop in economic activity. In other words, a lot less bread is being purchased and a lot less bread is being baked. The typical fix for this at a high level is to get banks up and running again so that cash and credit become available to consumers and businesses again. In order to recapitalize banks, it is usually necessary for governments to borrow money and for central banks to print money. But let's say you are the president and you are under political pressure because voters justifiably want to teach reckless bankers a lesson. You decide you will not bail out any banks and you will not allow the government to increase its debt burden. You also do your best to pressure the independent central bank into not printing any more money. In this case, how would you stop the debt death spiral? How would you quickly get money and credit into the hands of households and businesses to stop the accelerating domino effect of failing businesses and banks from spreading? For hundreds of years, for as long as financial crises have existed, political leaders, Nobel Prize-winning economists, and regulators have tried to answer this very question. Unfortunately, as of yet, no one has found an answer that does not involve saving systemically important financial institutions and banks. Politicians are often selfish and self-interested people. They often put their own fortunes above those of society. And they understand that if they bail out banks during a depression, they are very likely to get voted out of office during the next election by an angry electorate. Despite all this, time and again, politicians do actually bail out banks. Why? Because the alternative is so horrible, they are forced to overlook their own selfish interest to get re-elected in order to save millions of people from deep suffering. Now let's take a step back recap and look at some historical examples. In practice, at a very high level, the solution is this. The economy has suffered a massive deflationary shock. Credit has collapsed. In order to fix the economy, you need to use tools that are reflationary and stimulative. You need to replace the credit that disappeared. As distasteful as this sounds, if you need credit flowing again quickly, you cannot let systemically important banks die. Due to the self-reinforcing and accelerating nature of debt death spirals, quick action can make depressions relatively short-lived and relatively inexpensive to fix, whereas delayed action can make depressions very long-lived and very expensive to fix. For example, in the 1930s, the government did the exact wrong thing during the Great Depression. As you will recall from our discussion above, what throws a healthy economy into depression is the reduced economic activity caused by a disappearance of credit. When credit disappears, consumers can't find money to buy bread. Bowing to political pressure, the government pushed austerity and tried to reduce debt. This reduced economic activity even further. In other words, when the problem was caused by consumers reducing their purchases of bread, austerity caused the government to stop buying bread as well. This in turn accelerated the deflationary spiral downward. At the same time, it slow-walked reflationary measures which appeared to bail out banks. The result was an unnecessarily long depression which lasted over 10 years and did not end until the beginning of World War II. In 2008, on the other hand, an appropriate mix of deflationary punishment and reflationary support was provided quickly, leading to a relatively short-lived event that cost much less to fix compared to a drawn-out depression. Quick action makes depressions a lot shorter and less expensive to fix. The problem is policymakers typically delay doing the right thing because of politics. In addition, there exists another factor which causes delay, and it is statutory. Since debt crises most often arise out of new unregulated lending institutions and instruments, often government policymakers, in other words, the central bank and the executive branch, do not have the legal powers required to intervene. New laws need to be passed to grant authority to policymakers to fix the situation. But new laws take time and require a functioning legislative body. A key point Ray Dalio makes is this. The two biggest impediments to managing a debt crisis are A, the failure to know how to handle it well, and B, politics or statutory limitations on the powers of policymakers to take the necessary actions. This is probably the most important idea raised in this entire series. Economics is complicated. This is why they give out PhDs in economics. Knowing the right thing to do during a debt crisis is very difficult. On top of that, the right thing to do, given the nature of debt crises explained above, is guaranteed to be counterintuitive and extremely unpopular politically. Even when a nation's political system is functioning in a normal manner, persuading politicians to act against their own self-interest and do the politically unpopular thing quickly to save an economy is a touch-and-go proposition. But when a nation's political system has broken down, it is an open question whether or not policymakers will be allowed to fix an economy if a depression hits. Think about our situation today. If a depression hits and the correct fix is not applied, what do you think will happen? The most obvious historical analog is the 1930s. A prolonged depression in the 1930s was followed by global war in the 1940s. Below is a brief summary of 4 tools used to combat deflationary depressions. Number 1. Austerity. In other words, cut government spending. Raise taxes. This tool is politically popular because it appears to be responsible. This tool also makes a deflationary depression even worse. Number 2. Printing money and saving systemically important institutions. This tool involves doing 2 things. First, prevent the financial system from collapsing. At this point in the crisis, banks are failing left and right due to bank runs caused by fear. Policymakers must pick and choose which banks to save and which to let fail to ensure the survival of the overall financial system. At the same time, they must figure out how to do this while minimizing the cost to taxpayers. What can the government do to prevent the collapse of important institutions? They can guarantee liabilities and inject capital, provide liquidity, support the solvency of institutions by promoting mergers and adjusting accounting regulations, recapitalize, nationalize, and cover the losses of systemically important institutions. The funds required for this activity comes from printing money and from the government budget process. Second, stimulate the economy and ease the credit crunch by printing money. This tool is very unpopular politically because it sounds like the government is bailing out the banks and printing money irresponsibly. But they are necessary. As explained above, the depression has collapsed the economy's credit market. Credit lending has dropped precipitously, and the lending that does occur is done at exorbitantly high rates. When you have deflation, you need some way to inflate the economy and get lending going again. Printing money brings down interest rates, so bakers can afford to borrow money to buy flour. Printing money also encourages more banks to start once again offering loans to said bakers. Number 3. Debt defaults and restructurings. During a depression, banks hold a lot of bad debts on their balance sheets. Bad debts are loans that banks made which they now know will not be repaid. Until these bad debts are cleansed from bank balance sheets, normal lending levels cannot resume. Using a variety of measures, such as asset management companies, Bad debts are taken off the books of banks and debts are restructured. Systemically important banks are saved. Less important banks are allowed to fail. This tool also is quite unpopular politically. It sounds like reckless bankers are being bailed out. On the other hand, as explained above, how do bakeries begin baking bread again if there are no banks willing to lend them money to buy flour? Number 4. Redistributing wealth from the rich to the poor. This tool typically takes the form of income, property, and consumption taxes. A beautiful deleveraging results when the 4 policy tools mentioned above are mixed in an optimal way to produce a combination of the following: a minimization of shocks, positive growth, falling debt burdens, acceptable inflation. Put another way, the ideal deleveraging occurs when enough stimulation via printing of money and currency devaluation occurs to offset deflationary tools like austerity and defaults, so that the nominal growth rate rises above the nominal debt interest rate. In other words, you get income growing slightly faster than debt, so that mathematically debt begins to get paid down. But you have to thread the needle. Too much growth versus debt, and you get inflation. Too little, and you get deflation and growing debt. If you are a politician and you are interested in staying in power, there is a temptation to overdo things and print more money than is needed to boost growth in the short term. This is what happened to the Weimar Republic in Germany post-World War I. It resulted in a very ugly depression, accompanied by hyperinflation. On the other hand, in the 1930s, politicians in the US bowed to political pressure to punish irresponsible bankers. In this case, a reflation did not occur. Deflationary measures like austerity and defaults were favored. Stimulative or reflationary measures like printing money and devaluing currency were not applied quickly and vigorously enough. As a result, the Great Depression ground on for over 10 painful years, finally ending with the onset of World War II. Ray Dalio studied 48 big debt crises, representing most of the crises that have occurred over the last 100 years to look for patterns. All of the deleveragings that Ray Dalio has studied eventually required the following: big waves of money creation, large fiscal deficits, and currency devaluations against gold, commodities, and stocks. The money creation occurs in 2 waves. First, to provide liquidity to distressed institutions, and then large actions to broadly stimulate the economy as a whole. Stage 6 is called pushing on a string. Towards the end of a long-term debt cycle, policymakers sometimes struggle to convert their policies into increased spending because the effects of their 2 main tools, interest rate reductions and central bank purchases of debt assets, have petered out. At such times, the economy enters a low-growth stage. This period is referred to as pushing on a string. To boost growth, policymakers have to try other tools, which more directly direct money and credit to spenders. To take a step back, at this point in the debt cycle, there are 3 kinds of monetary policies available to policymakers. Monetary policy 1 involves interest rate reductions and has been explained above already. Monetary policy 2 is called quantitative easing. This policy involves printing money and buying financial assets on a massive scale. A full treatment on quantitative easing is beyond the scope of this talk, but in summary, at a very high level. Quantitative easing refers to when a central bank buys a bond from an investor. This act puts cash in the hands of the investor. The hope is threefold. First, that the investor will use that cash to spur spending. Second, that large-scale purchases of bonds will reduce risk premiums. When risk premiums drop, interest rates on debt drop. Cheaper loans make it easier for bakers to borrow more money to purchase flour and make more bread. Lower interest rates spur economic activity. Third, lower interest rates raise the prices of bonds and other assets like stocks. This creates a wealth effect. When people see their stock portfolio rising, they feel wealthier and more secure. As a result, they feel more comfortable spending money. The problem is towards the end of a big debt cycle. This tool also loses power basically when quantitative easing forces risk premiums down close to 0. When monetary policy 1 and 2 are all used up and there is no gas left in the tank at the central bank, policymakers turn to Monetary Policy 3. Monetary Policy 3 represents a diverse set of tools aimed at giving money directly to spenders and not investors. The goal of Monetary Policy 3 is to boost spending. Some of these tools represent coordinated fiscal and monetary policy. Others represent tools with very little coordination between fiscal and monetary policy. Examples of Monetary Policy 3 include debt-financed fiscal spending, printing money and giving it directly to the government to spend, helicopter money, that is, giving money directly to households, and macro-prudential policies, etc. The final stage in the big debt cycle is called normalization. Eventually, if policymakers are able to thread the needle during the beautiful deleveraging and pushing on a string phases, thus avoiding prolonged periods of inflation or deflation, the economy normalizes and gets back to a safer position to begin possibly a new big debt cycle. Now that we've covered the entire big debt cycle framework for deflationary debt cycles, you're in a position to decide if you think Ray Dalio may be correct, and if so, decide what that means for how you want to invest right now, given that Ray Dalio suggests we may be towards the tail end of a big debt cycle. Why is this important for you and your family to think about? Consider the Great Depression of 1929 to 1941. Consider that it lasted over 10 years, and consider the tremendous social disruption and war that followed this event. Millions of families went bankrupt and became homeless. Imagine your family losing everything during a financial crisis. The Great Depression started in 1929. If it was 1928, a year before the crisis, would you want to know ahead of time what was about to occur so you could prepare? The point of Ray Dalio's book is not that he is saying it is 1928, in my opinion. What I believe Ray Dalio is saying is this. After analyzing 48 big debt crises that have occurred over the last 100 years, there is a pattern. And statistically, the pattern indicates we may be on the cusp of another big debt crisis today, mainly because our nation's total debt, which includes U.S. federal debt, plus state debt, plus local debt, plus private debt, has crossed a statistical threshold associated with bubble-induced depressions. Ray Dalio's main point is the U.S. might now be in a fragile position because large amounts of debt may have fueled a system threatening bubble hidden somewhere in the economy. This bubble, if it exists, may burst tomorrow. It may burst 10 years from now. It might not exist at all. So that is point number one. Due to all this debt we have, there may be a system-crashing bubble somewhere hidden in the economy right now. Point number two is this. Ray Dalio says, the two biggest impediments to managing a debt crisis are A, the failure to know how to handle it well, and B, politics or statutory limitations on the powers of policymakers to take the necessary actions. On the positive side, economics is a science like physics or medicine. Over the last 100 years, we have learned a lot. And what is reassuring is we now have a lot of experience with fixing depressions. We've learned a lot. In addition, as a result of navigating many prior depressions, our nation has put in place a legacy of laws and institutions to help our leaders to address future crises. In case a bubble does burst sometime over the next 10 years, our leaders know what to do, and our nation has laws in place that go a long way towards authorizing our leaders take the required action. That's a great legacy bestowed on us by past generations. The problem, though, is politics. Because the correct actions to fix a depression are by nature highly unpopular politically. In the past, during times of crises, we as a nation have had to rely on our politicians to put down partisan politics and unite during times of danger for the greater good. If you read the history of past financial crises, you will note that achieving this unity has most often been a very touch-and-go situation. Often, our nation only just barely did the right thing in the nick of time after much political infighting. Ray Dalio's entire book, therefore, boils down to one simple question. If a crisis hits, are you confident that our politicians will unite for the greater good? When you look around the political landscape today, if a bubble were to burst threatening a new Great Depression, are you confident our political leaders will put aside petty political differences and do the politically unpopular thing to fix a depression and unite? If you are confident our political leadership will unite across party lines, the next depression will probably look like 2008. Painful but quick. On the other hand, if you are not confident in our political leadership's ability to unite, that means you think that if a bubble bursts, our government may greet a financial crisis with inaction or the wrong actions. Given the accelerating nature of debt death spirals, delayed action creates exponentially worse outcomes. In this scenario, we are looking at a depression that lasts several years and is quite severe. As an added twist, typically for nations that control a reserve currency, depressions take on a deflationary tone. In other words, during a deflationary depression, year after year, the price of goods and services falls. Every year, bread gets cheaper and cheaper. Deflationary depressions are easier to manage than inflationary depressions. Hence, this is one of the benefits that accrues to a nation that owns a reserve currency. The US controls a reserve currency, and it is called the US dollar. So historically, we were relatively unlikely to encounter inflationary depressions. Inflationary depressions are characterized by depressions where every year the price of goods and services rises. In general, inflationary depressions are much more difficult to fix. During a period of severe political dysfunction, it is conceivable that a government could overemphasize reflationary policies during a depression and print too much money to allay internal political pressures. In this case, the US could experience a heretofore improbable inflationary depression. Compounding all of the above is if you look at other nations around the world, the US is not alone in having piled up a dangerous amount of debt. According to the IMF's Global Debt Database, concern about debt is a global issue. Many other nations have significant debt issues right now. There is an old saying, when the US catches a cold, the rest of the world gets a fever. What would the knock-on effects be of a US debt crisis on the rest of a debt-ridden world? Or conversely, does a bubble exist somewhere outside the US which might knock the US into a crisis as well? Based on my view of the world, I personally have applied percent probabilities to each possible political outcome and adjusted my investment portfolio accordingly. In a future video, I will explain, compare, and contrast how Ray Dalio and Warren Buffett, among others, would suggest you invest prior to the onset of a depression-level event. What percent probabilities would you apply to these political scenarios? What do you think might happen? I believe the reason why Ray Dalio took time out of his busy day to write this book is because he believes there is significant cause for concern right now globally, and he is trying to get our world leaders to act. What do you think? This video was sponsored by Stream.com. Stream is the world's best shopping list app. Stream believes life should be simple. Stream's shopping list app features a simple design, and it's super easy to share a shopping list with friends, family, and coworkers. Try Stream.com today. That's Stream with 3eyes.com. Thanks for watching. Please like, comment, and subscribe.